So, what is Forex? The simplest answer to the question posed is to think about it as a marketplace where currencies are bought and sold. In this training video, we will be introducing you to the concepts applied to the Forex market, but it is helpful to know that most of the theory can ultimately be transposed into other market types. That said, beware. There are a couple of significant differences between them that can and sort of do have an impact in the way that you trade. So it is important that you understand these differences before you endeavor into unfamiliar territory. ACM Gold offers you the ability to trade in other types of markets commonly known as financial instruments. So let us take a step back and have a brief look at the two categories of financial instruments that ACM Gold offers. The first one is spot Forex, for example, Euro versus US dollar. The second one is spot commodity metals, like gold versus the US dollar. It is now common knowledge that Forex is a marketplace where buyers and sellers gather to barter in currencies. But what is also imperative to realize is that our modern-day method of trading means that you do not trade any tangible currency, and in addition, you're not required to trade through any exact location. We all meet as various players in cyberspace through the most cutting-edge and sophisticated network ever created in order to purchase and vend electronic currency solely for having the chance to profit from fluctuations. Awesome! Over-the-counter markets. In contrast with other financial markets such as stocks, bonds, or futures markets, the Forex spot market has no physical location or central exchange. The Johannesburg Stock Exchange and the New York Stock Exchange are fine examples of a central exchange market. Any transaction has to run through this central exchange, which in turn regulates and fixes the buy and sell prices. That makes the price tag for transacting a whole lot more expensive. The Forex market, on the other hand, is unique and is considered an interbank market, which means the entire market is decentralized and run electronically within a web of banks, continuously over a 24-hour period, 5.5 days a week. Contrary to popular belief, even traders need to rest over the weekends. But this means that the Forex market is worldwide, allowing for an exponentially growing quantity of daily trade volumes as well as market players. Also, this allows us to trade from anywhere in the world at a fraction of the cost of dealing in an exchange-controlled environment. In an OTC market, participants choose who to trade with depending on appeal of prices, reputation, and trading conditions. Having such a decentralized system also encourages competition because a larger number of players are involved in determining buy and sell prices, thus reducing the cost to deal and forcing better quality of service for buyers and sellers. So you see, trading with currencies and metals through ACM Gold is not going to cost you a small fortune. Ultimately, ACM Gold becomes your partner as you endeavor to trade successfully, because in essence, you have to borrow large amounts of currency to make significant profits on the market, and ACM Gold advances you the money cost effectively. So rest assured, we're fully behind you. Okay, now we know what the market is and how big it is, but how big is it really? The Forex market has only been accessible to individual traders for the past 10 to 15 years, and in the grand scheme of all markets, it is the youngest by far. But it is, however, grown to be the most dynamic and largest with a daily trading volume of around $4 trillion. Now, ACM Gold operates within the spot market, which accounts for about $1.5 trillion, but all the same, we're still trading the giant of all markets as $1.5 trillion still overshadows all other players. Market players. Before the dawn of the new millennium, only the big banks, the large institutions and central banks could take advantage of the opportunities provided by this market. The revolution changed fundamentally because of the shift in two key areas. Number one, technology, the birth of the internet and digital technology, without which none of this would be possible. And two, online trading firms, the birth of a company such as ACM Gold. Believe it or not, it would not be viable for you to trade the markets without an online trading firm. All right, now let's discuss the chief players in the market in a bit more detail. Governments and central banks. Governments and central banks take part in the Forex market for their operations, for global trade payments, and managing their foreign exchange reserves. Central banks in particular impact the Forex market when they adjust interest rates to control inflation and the supply of money, thus affecting currency valuation. The big, and we mean big, banks. The largest banks in the world determine the exchange rates by making the buying and selling prices based on the supply and demand for currencies. The large banks are collectively known as the interbank market, and about 10 of them account for over 85% of all transactions. A couple of these powerhouse banks include UBS, Barclays Capital, Deutsche Bank, and Citigroup, and probably one of the biggest we know, JP Morgan. Large commercial corporations. Corporations take part in the foreign exchange market for two reasons. A, the purpose of conducting business, and B, mergers and acquisitions. The speculators. These days, speculators make up close to 85% of all trading volume, and they come in all shapes and sizes. Some have fat pockets, some roll thin, but all of them engage in the Forex market simply to make as much profit as they can. Retail Forex brokers. Brokers basically come in two forms, but the important element is to realize that there are a variety of forms of brokers within these models. The first being electronic communications networks, and these use the best bid and ask prices available to them from different institutions on the interbank market. The other one is market makers, and as their name suggests, they make or set their own bid and ask prices themselves. There are, however, important variations that set apart the difference between a market maker and a broker. The basics of currencies. Now, this chart shows the 10 most actively traded currencies. The dollar is the most traded currency, taking up 84.9% of all transactions. The euro's share is 39.1%, while that of the yen is third at 19.0%, and so on. Because two currencies are involved in each transaction, the sum of the percentage shares of individual currencies is 200% instead of 100%. This chart shows just how often the US dollar is traded in the Forex market. It is on one side of a ridiculous 84.9% of all reported transactions. It's a must to pay attention to the US dollar because the US dollar is clearly king. In fact, according to the International Monetary Fund, or IMF, the US dollar comprises almost 62% of the world's official foreign exchange reserves, because almost every investor, business, and central bank pretty much owns it. Now, currency symbols always have three letters, where the first two letters are the name of the country, and the third letter identifies the name of that country's currency. Take the New Zealand dollar, for instance. Currencies are traded in pairs. Forex trading is the simultaneous buying of one currency and selling of another. Imagine each pair constantly in a tug of war, with each currency on its own side of the rope. Exchange rates fluctuate based on which currency is stronger at the moment. Major currency pairs. The currency pairs listed here are considered the majors, and these pairs all contain the US dollar on one side and are the most frequently traded. The majors are the most liquid and widely traded currency pairs in the world. And these are the euro dollar, the dollar yen, the pound dollar, dollar Swissy, dollar loonie, Aussie dollar, and the Kiwi dollar. There are also other types of pairs besides the major currencies which are less traded and come in the form of major cross-currency pairs, which are pairs that do not contain the US dollar. They're also known as minor currency pairs like the euro-yen. And they also come in the form of exotic currency pairs, which are major currency versus an emerging economy currency. For example, the US dollar versus the South African rand. Characteristics of Forex. No commissions, under normal circumstances. Under normal circumstances, there are no clearing fees, no exchange fees, no government fees, no brokerage fees. Most retail brokers are remunerated for their services through something called the bid-ask spread. But be warned, some intermediaries can charge commission on top of the spreads, although ACM Gold does not charge any additional commissions. It's crucial to define whether a broker is subject to financial regulations in their appropriate jurisdictions, as this defines their capital requirements and anti-money laundering policies and general financial regulation policies. No fixed lot size. In spot Forex, a trader determines their own lot or position size. This allows traders to participate with small amounts and effectively control their risk and reward precisely. Low transaction costs. The bid-ask spread is typically less than 0.1% under normal market conditions. A 24-hour market. This is awesome for those who want to trade on a part-time basis because you can choose when you want to trade. Morning, noon, night, during breakfast, or in your sleep. Okay, I'm just kidding. You can't trade in your sleep. No one can corner the market. No single entity, even a central bank, can control the market price for an extended period of time. High liquidity. Because the Forex market is so colossal, it is also extremely liquid. You're never stuck in a trade. The Forex market structure. Trading spot FX is decentralized. Unlike in trading stocks, you don't need to go through a centralized exchange. In the Forex market, there is no single price for a given currency at any time, which means quotes from different currency dealers will vary. Furthermore, one tremendous advantage about Forex trading is that you can do it anywhere as long as you have an internet connection and access to your trading platform. Before looking at the best times to trade, we must look at what a 24-hour day in the Forex world looks like. The Forex market is broken up into 4 major trading sessions. The Sydney session, which opens at around 9 p.m. UTC, the Tokyo session, which opens at around 11 p.m. UTC, the London session, which opens at around 8 a.m. UTC, and the New York session, which opens at around 1 p.m. UTC. How you make money in Forex. The object of Forex trading is to exchange one currency for another in the expectation that the price will change, so that the currency you bought will increase in value compared to the one you sold. An exchange rate is simply the ratio of one currency valued against another currency. For example, the euro-dollar exchange rate indicates how many dollars can purchase 1 euro. In this particular example is 1.9197. How to read a Forex quote. Currencies are always quoted in pairs, such as the pound dollar or dollar yen. The reason is because every foreign exchange transaction entails you simultaneously buying one currency by selling another first. The first listed currency to the left of the slash is known as the base currency, in this example the euro, while the second one on the right is called the counter or quote currency, in this example the US dollar. When buying a currency pair, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. So in this example, you have to pay 1.2906 US dollars to buy 1 euro. When selling a currency pair, the exchange rate tells you how many units of the quote currency you get for selling 1 unit of the base currency. And in this example, again, you will receive 1.2906 US dollars when you sell 1 British pound. The base currency is the basis for the buy or sell. If you buy euro dollar, it means that you're buying the base currency and selling the quote currency. You would buy the pair if you believe that the base currency is going to appreciate relative to the quote currency. This is called going long. And you would sell the pair if you think the base currency will depreciate relative to the quote currency, and this is called going short. Bid and ask. All Forex quotes are quoted with 2 prices. The bid price is the price at which your broker is willing to buy the base currency in exchange for the quote currency. The ask price is the price at which your broker will sell the base currency in exchange for the quote currency. The difference between the two is popularly known as the spread. If you want to sell euro, you click sell, and you will sell euros at 1.29376. If you want to buy euro, you click buy, and you will buy euros at 1.29413. Rollover. For positions open at your broker, if you're buying a currency with a higher interest rate than the one you're selling, then the net interest rate differential will be positive. You will earn funds as a result. Conversely, if the interest rate differential is negative, you have to pay. Every broker or dealer has specific and different policies regarding rollover. The cutoff time is 11 p.m. UTC plus 2 hours every day. If you do not want to earn or pay interest on your positions, simply make sure they're all closed before this time. The established end of the market day. Interest is paid in the currency that is borrowed and earned on the one that is bought. Also note that many retail brokers do adjust their rollover rates based on different factors like account leverage, interbank lending rates, etc. Now here's an example of the interest rate differentials of the major currencies, which naturally are continuously fluctuating. For the United States, it's benchmarked at 0.25%, for Japan 0.1%, for New Zealand 2.5%, and so on. In ACM Gold's trading platform, however, it is really easy to see if you can earn or pay interest. All you need to do is check out the contract specifications page for each pair, and it is immediately available. In this particular example, we can see that if we went long, we would pay $3.5 per standard lot or contract of 100,000 units of base currency every night. But if we went short, then we would actually earn $0.93 for every evening for every standard lot. Calculating the value of pips. The unit of measurement used to express the change in value between two currencies is called a pip. If euro dollar moves from 1.2902 to 1.2903, that is 1 pip. For calculation purposes, it is far easier to use 4 decimal points for all currency pairs without the yen, and 2 decimal points wherever the Japanese yen is part of the pair. To work out how much a pip is actually worth in currencies where the US dollar is quoted first, the calculation would be as follows. For the dollar Swissy at 0.9327, Well, remember we said earlier that the pip is the fourth decimal. So 0.0001, which is 4 decimal places, divided by the exchange rate equals the pip value. So you take your 0.0001, divide it by 0.9327, and that gives you 0.000010721. And that will be your pip value in euros. For the dollar yen at 77.77, we said earlier that the pip is the second decimal for any currency pairs involving the yen. So 0.01 divided by the exchange rate, that's your pip value. And for this particular pair at this exchange rate, 0.0000128 will be the pip value. Just bear in mind that this is what we would be earning if we were to trade 1 unit of the base currency. Now, in the case where the US dollar is not quoted first, and we want to get the US dollar value, we have to add one more step. Let's take the euro dollar at 1.3034 as an example. So 0.0001 divided by 1.3034, and that will give you 0.00007672 euros. Now we need to convert it back to the US dollar, hence the pip value times the exchange rate, and that's 0.00007672 times 1.3034. That will give you 0.00009999, which, is 0.0001. Therefore, the pip value is 0.001. And if you repeat this for any other pair where the US dollar is the quote currency, you will find that it is a standard figure of 0.0001. Fortunately, you don't have to work this out all the time. ACM Gold will work it out for you automatically. Lots, leverage, and profit and loss. Having touched on the various types of lot sizes, let's break it down again just to ensure that we have a good idea. A standard lot is 100,000 units, a mini lot 10,000, and a micro lot 1,000. ACM Gold impressively allows you to trade standard, mini, and micro lot sizes as well as fractions of these. On the ACM Gold system, one standard contract would be represented as a volume of 1. A mini lot then would be represented as a volume of 0.1 and a micro lot as 0.01. So let's assume we'll be using a 100,000 unit lot size, which is a standard lot. We will now recalculate some of the examples to see how it affects the pip value. So dollar yen at an exchange rate of 78.12, that is the pip value multiplied by 100,000. That'll give you $12.80 per pip. And the dollar franc at an exchange rate of 0.9280 gives you $10.78 per pip. In cases where the US dollar is not quoted first, the formula is slightly different. Euro dollar at an exchange rate of 1.3107, the pip value multiplied by 100,000 is 7.63, and multiply that by the exchange rate again, you get $10 per pip. Pound dollar at an exchange rate of 1.6225, again, the pip value multiplied by 100,000 multiplied by the exchange rate gives you 9.9946, and it's rounded up to $10 per pip. If we traded different contract sizes, then the calculation stays the same. All we need to do is change the amount of currency units. Great, so we now know that we'll be earning more per pip if we trade higher amounts. But the question is, how are we able to trade higher amounts if we don't have them? Well, there comes the concept of leverage into play. You're probably wondering how a small investor can trade such large amounts of money. Think of your broker, who in turn uses a primary broker like Boston Technologies, as a bank that basically fronts or loans a certain amount of money to a trader in order to allow them to sell that currency and exchange it into another currency. allow the exchange rate to move, and reconvert the same amount back at a different rate to generate a profit. The amount of leverage you use will depend on your broker and what you feel comfortable with. Typically, the broker will require a trade deposit, also known as margin or initial margin. ACM Gold starts your demo and live accounts at a leverage of 100 to 1, which is more than sufficient. However, you do have the option to change this to higher or lower should you wish, simply by electronically requesting it. To calculate the margin or deposit that is required to take out the position, we use the following equation. Number of lots multiplied by amount of currency multiplied by exchange rate over leverage. So therefore, our margin above here would be 1 times 10,000 times 1.3800 divided by 100. This works out to $138, meaning that to borrow 13,800 and sell it and convert it to 10,000 euro, we have to put down $138 in margin. How to calculate profit and loss? Let's buy US dollars and sell Swiss franc. The rate you are quoted at is 0.9268, 0.9272. Because you're buying US dollars, you'll be working with the ask price, and that's 0.9272. So, you buy one standard lot at 0.9272. A few hours later, the price moves to 0.9292, and you decide to close your trade. The new quote for dollar franc is 0.9292, 0.9296. And since you're closing your trade, you now sell in order to close it, and you take the bid price at 0.9292. The difference is 20 pips. Now, using our formula, we now have 0.0001 divided by 0.9292. Multiply that by 100,000. That's $10.76 per pip. Multiplied by 20, $215.20. Remember, when you enter and exit a trade, you're subject to the spread in the bid-offer quote. When you buy a currency, you will use the offer or ask price, and when you sell, you use the bid price. When you decide to close a position, the deposit you originally made is returned to you, and the calculation of your profit or loss is done, and this is credited or debited to your account. A new customer should always use a stop loss, and a novice trader should not be trading more than one mini contract per $1,000 capital invested. At any given point of the time in the market, this means if a 30 pip stop loss is hit while your balance was $1,000 and you traded one mini lot, it will equal $30, which is 3% of the trader's account. To truly gain a good understanding, we've broken down the explanations into different scenarios as to whether the US dollar is the base or quote currency, whether we bought or sold a currency pair, and naturally if we made a profit or loss, and each scenario uses a standard mini or micro lot. Scenario 1. Calculating a profit or loss by buying a currency pair where the US dollar is the quote currency. So let's say, for example, you decide to purchase 100,000 euros at the euro-dollar exchange rate of 1.3021, 1.3024. So you would purchase it at 1.3024, that being the ask price. You would need 130,240 US dollars. A day later, you exchange your US dollars back to 100,000 euros at 1.3074. So that would be 130,740 US dollars back. You end up earning a profit of $500, which is 50 pips. Remember, it's $10 per pip. Now, in a scenario where the exchange rate decreases in value, again, let's say we're using the exchange rate of 1.3024 with the euro dollar, and you bought 100,000 euro, but this time the exchange rate moves to 1.3018. So in this case, you sell your 100,000 euro, then get back 130,180 US dollars, and that's a negative $60 loss. All right, so calculating a profit or loss by buying a currency pair where the US dollar is the base currency. Let's say, for instance, you decide to purchase 250,000 US dollars, which is 2.5 standard lots, at an exchange rate of the dollar Swissy 0.9287. That means you would buy 250,000 US dollars using 232,175 Swiss franc. And later, your exchange rate goes up to 0.9305. And so to sell back your 250,000 US dollars, you would now get 232,625 Swiss franc. And that's a profit of 450 franc. However, to understand the value of your profit, you have to convert the franc back to US dollars. And at the exchange rate of 0.9305, that's $483.84. And the same would apply for when the exchange rate decreases in value. Using the same exchange rate, however, if the value were to change to 0.9282, you would then get back 232,050 franc instead, which reflects a negative 125 franc loss. And converting it back to US dollars would get $134.65. Types of orders. The term order refers to how you will enter or exit a trade. We'll look at the different types of orders that can be placed into the Forex market with the ACM Gold trading platform. The market order. A market order is an order to buy or sell at the best available price, commonly known as the market execution. In this example, the bid price for euro-dollar is currently at 1.28651 and the ask price at 1.28652. Pending orders. A pending order is an order placed to either buy below the market or sell above the market at a certain price. Pending orders come in the form of buy limit entry orders, buy stop entry orders, sell limit entry orders, and sell stop entry orders. For example, if the euro-dollar is trading at 1.2803, you want to go short if the price reaches 1.2833. You can either sit in front of your monitor and wait for it to hit 1.2833, at which point you would click a sell market order, or you can set a sell limit order at 1.2833, then walk away from your computer to attend to your, ballroom dancing class. If the price goes up from 1.2834, remember it has to breach your price by 1 pip to execute the order. So if it goes up to 1.2834, your trading platform will automatically execute a sell order at the best available price. Stop loss order. A stop loss order is a type of order linked to a trade for the purposes of preventing additional losses if the price goes against you. Always use a stop loss to protect yourself in the market. A stop loss order remains in effect until the position is liquidated or you cancel the stop loss order. For example, if you went long on euro-dollar at 1.3138, to limit your maximum loss, you set a stop loss order at 1.3108. This means that if you were dead wrong and the euro-dollar drops to 1.3108 instead of moving up, your platform would automatically execute a sell order, the best available price, and close out your position for a 30 pip loss. A profit limit order. A profit limit order is specifically designed to execute an order when you reach a certain amount of profit. Now, why would you want to do that? Remember that while your trade is in the market, you are in actual fact in a floating profit, meaning that you have not realized your profits yet. Since the market prices fluctuate up and down, it is natural and important to bank profits at a certain stage. Using a profit limit also gives you the power to not have to monitor the markets the whole time, which is not really healthy. But you'd still have the reassurance that when the prices hit a certain profit point, you will be taken out of the market in profit. A trailing stop. A trailing stop is a type of stop loss that follows the price at a predetermined distance, but only once the price has breached that certain point, but stops moving when the price begins to move in the reverse direction or in loss. For instance, if you've decided to short dollar yen at 77.91 with a trailing stop of 20 pips, this would mean that originally your stop loss is at 78.11. If the price goes down and hits 77.61, your trailing stop would move down to 77.81. Using a trailing stop requires a lot of experience and practice, so we would advise starting with traditional stop loss and profit limit orders. So now that we've covered types of orders, let's look at the risk-reward ratio. Risk is the distance between the stop loss and the entry price. Reward is the distance between the entry price and the target. One of the most common mistakes is traders often win much smaller amounts when they are right, but lose bigger amounts when they're wrong. So a risk-reward ratio in Forex is the number of pips that you risk if the price reaches the stop-loss point versus the number of pips you'll gain if the price hits your take-profit limit. It must always be greater than 1:1. But not only greater than 1:1, it should be preferably between 1:2 and 1:3. For example, with the ratio 1:2, you'd have a 20 pip stop loss and a 40 pip profit limit. With a ratio of 1:3, you'd have a 20 pip stop loss and a 60 pip profit limit. Try as much as possible to trade in between this range. Hedging. Direct hedging is when you're allowed to place a trade that buys a currency pair at the same time, placing a sell trade on that pair. So the net profit is zero if you have both trades open. So you can make money without incurring the risk if you time the market just right. So the general rule of thumb, and we'll leave you with this, the ideal trading scenario is never to risk more than 3% of your capital at any given time.